Today, we come to expose our work based on Investment Optimal Portfolio. Our group consists of Maria Jose Lopez, Gabriela Andaño, Andres Abella, and myself, Juan Diego Basurto. In this presentation, we will discuss the analysis of portfolio choice under optimization model based on Markowitz theory, where the objective of portfolio optimization is to maximize its benefits and reduce its level of risk. Since it is necessary for investors to find tools that allow them to create their best possible portfolio. This task is not so easy because in today's financial markets, we are confronted with a multitude of assets with different levels of liquidity, volatility, return on risk. In the following, my colleague Andrew will give more details explaining the different variables involved in this problem.
Thanks Juan Diego for the introduction. Well, I'm going to explain you all the important definitions to understand the purpose of our project and their relationship with probability. The first one is the investment portfolio. In finance, a portfolio is a collection of different assets or financial instruments such as equity, bonds, or cash. With the objective of obtaining profit from the market, this combination of investments can be made by an institution or an economic agent. The second one is a financial asset, which is an instrument that gives its buyer the right to receive future income from the seller. They can be issued by an economic unit, company, government, etc. Financial assets don't usually have a physical value. The buyer of a financial asset has a right and the seller an obligation. Other important definitions are financial return and financial risk. The first one refers to the percentage of profit that is obtained with respect to the investment during a certain period of time. And the second one is the uncertainty produced in the performance of an investment. This is due to the changes produced in the sector in which it operates, the impossibility of return of capital by one of the parties, and the instability of the financial markets. What we are going to focus on with this work is diversification. This refers to the choice of different financial investment instruments that make up the portfolio. You are probably wondering why this is the central theme of the work, and the answer is that only thanks to this we can understand the degree of correlation and therefore the covariance that exists between the different assets that belong to a portfolio, and remember that the degree of optimality of a portfolio is given by the diversification of the assets among the portfolio. Taking into account that the less they are related implies a better portfolio.
Now that we know what are the financial terms that we will use, I can explain a little further how we can use probability and statistical variables in finances and specifically in the assets market. I will start with the definition of the measures and variables, and then I'll proceed to explain its use on the financial area. First, we have the variance, that in finances, specifically in investments, means volatility, because it is a measure of the frequency and intensity of changes in the price of an asset. This measure gives us the risk of a particular asset and helps us choose the assets in which we want to invest depending on how much risk we want on our portfolio. Second, we have the standard deviation. In the case of an investment's annual rate of return, it doesn't only provide an insight into the historical volatility, but it also predicts future return tendencies. We also have that the greater the standard deviation, the greater the variance between each price and the mean, indicating a greater range of prices. In that way, a large dispersion indicates how much the asset's return deviates from the normal expected return. Third, we have the covariance. It is the basic data to determine whether there is a dependence between two variables. In this case, we can achieve a diversified portfolio by choosing assets with low covariance. In this way, the assets will have less volatility and less general risk because it means that the prices of the assets don't move in the same direction. Covariance between an asset and the market can also be helpful, since it is used in the formula of the beta coefficient, which we will talk about later. Fourth, we have the correlation coefficient. It is used to determine the degree of correlation between the different prices and expected returns of the assets. This will help us choose the optimal portfolio because we do not want that the assets we choose are positively correlated, because that means that if one of them lowers its price or expected return, the other one would lower as well, enabling monetary losses for the investor. In this case, to diversify our portfolio and reduce risks in our investments, we would prefer the assets that are negatively correlated. Lastly, we have the beta coefficient. This ratio compares the systematic risk of an asset by measuring its expected returns volatility relative to the average return of the market in which it is traded. The more volatile an asset is relative to the market index, the greater it is the market risk. When beta is equal to 1, we have a neutral value. That means that the assets move in the same proportion as the index or has the same systematic risk. When beta is greater than 1, we have an aggressive value. This means that the asset has a higher volatility than the index, which shows that the asset has a higher risk than the market. When beta is lesser than 1, we have a defensive value. This means that the stock has less volatility than its benchmark or is less risky than the market. With this coefficient, we can have a better view of the volatility and systematic risk of a particular asset in comparison to its market. All these probability and statistical variables help us maximize the expected value we can get from a portfolio, by also minimizing the risk we must take to achieve it. And these are great tools to calculate and invest on an optimal portfolio.
The way to optimize a portfolio is by using the theorem created by the 1990 Nobel Prize in Economics Markowitz, that is based on the rationality of the investor, that is the desire for a return and the rejection of a risk. Therefore, for Markowitz, a portfolio of financial assets is efficient when it is composed of assets with high profitability but low risk. In addition, the correlation between assets is low, which is why they are highly optimal portfolios. This model uses three key hypotheses for its success. The first one is that the return of any portfolio is considered a random variable. The expected value is used to quantify the profitability of the portfolio. The second one is that the variance and standard deviation are taken to measure the dispersion as a risk measure of the random variable. And the last one is that the investor's decision goes the way of opting for a portfolio that generates higher returns while assuming minimal risk. The objective of the problem is to maximize profits and obtain the proportion of each asset in which to invest.
Now, with the definitions, the objective, and the hypothesis, we can start doing the optimization problem to choose the optimal portfolio according to the investor's profile. Using the Markowitz model, we have two paths to choose the best one. Besides, we need to understand that among the portfolio we have different assets that have their own variance and expected value. So, if we want to have the variance of a portfolio, we need to make the summatory of the product of the proportion of the assets with the covariance, that at the end is the relationship between the assets. The mathematical process for the expected returns of the portfolio is similar. You must make the summatory of the product of the proportion invested in the asset with the expected returns that this one has. It is important to consider that the summatory in both procedures are from 1 to the number of assets each portfolio has. Now, according to Markowitz, the first path is the minimization of the variance of the portfolio returns subject to the expected value of the returns of it. This first optimization problem is for an investor that wants to prevent high risk. This is because in finance, the risk of an asset is measured by its variance. In this way, by minimizing the variance, we are reducing the risk of the portfolio, taking into account the expected returns that this one has. The second path is a maximization problem in which you make a similar procedure than before, with the difference that you maximize the expected returns of the portfolio subject to the minimization of the variance that has the returns of it, which means the constraint is now the risk of the portfolio. Whatever path you decide to choose, both cases will find the weight of the assets that will optimize the portfolio, including the constraints this one is subjected to. It is very important to bring back the variance and expected value of the returns of each asset, because alongside the optimization problem, we need a matrix with those variables so we can have the risk of the financial assets. This information is key so we can have the volatility of all the variables. Overall, by doing these procedures, an investor can gather enough information to see the risk of an investment opportunity alongside the profits. One important conclusion we see is that if we want to reach the best portfolio, it is necessary to have a diversified portfolio, because by adding different assets, we reduce the risk. As a result, the selection of an optimal portfolio depends not only on the volatility and the risk of the assets in the portfolio, but also the profile and the objective the investor has. In the paper, we saw how the optimization procedure is useful for calculating all the data that becomes handy at the time an investor needs to choose the best portfolio. Hence, as we told you before, the importance of the Markowitz procedure is finding the missing variable, which is the proportion of money invested in each asset. Therefore, by doing the mathematical procedure, you start getting the weight of each asset so we can make up the portfolio, each portfolio, and generate the expected returns and risk. Finally, after doing the procedures, you sketch the efficiency curve. That in simple words is the graph where you can find all the optimal points containing the maximum returns each portfolio has, considering the risk. So, if we want the best portfolio, we need to graph each efficiency curve so we can compare them, allowing the investor to see what portfolio is the most efficient one, and from there invest in the assets within this portfolio.
After investigating the paper, we found effective investment methodology determined by the risks on liquidity disposition of the investors by a portfolio optimization, derived from perfect risk distribution and very good diversification. One of the disadvantages and criticisms of the model is that the volatility of a financial series is not considered. Finally, we bring this methodology to the Colombian market. Various problems may arise, like the small amount of assets offered in the Colombian market. An example of this is the fact that in the BBC, the market is approximately divided by almost two sectors, which are financial and oil companies, where these two have almost 75% of the entire market. This makes it difficult to the diversification that Markowitz method tells us. Our recommendation for this tool is that in Colombia is necessary to extend to other international markets that allow you to build an optimal portfolio with high profits and low risk level.